As the tax planning season kicks off, what can you do to make the most of your tax planning avenues? I'm joined by Feroze Azeez, Deputy CEO, Anand Rathi Wealth Management. Thanks very much, Feroze, for joining me on the show. I want to start by asking you that with tax planning season kicking off, one of the lesser known avenues is capital gains exemption bonds. Tell us what that really means and how does it work?
If you have a capital gains from an instrument, if you wish to exempt that gain from capital gains, you can invest in the capital gain exemption bonds and get a tax break on that and exempt yourself from the 20-22% long-term capital gains which you are liable to pay. For example, if you've sold your house of 3 crores at 3.5 crores, for example, the 50 lakhs could be invested in the capital gain exemption bonds, which are generally issued by REC and NHAI, these kind of companies. The return which these bonds give are marginally lower and they are taxable, but the 50 lakhs which is your gain if invested saves you 11 lakhs of tax.
Okay.
That comes under section 54 EC. Which is a very important but underused kind of an exemption, because in a ATC, for example, it's far more popular than a 54 EC. But in ATC, the maximum I would save is 50,000 rupees of tax. Here I can per annum save as much as 11 lakhs, which is 22 times more than ATC, but this is underutilized. So I would want to highlight 54 EC as being one thing which is underutilized but is very relevant. At some point in time in one's life, you will actually create capital gains which can be avoided if you actually use these bonds appropriately and you're vigilant enough to see their issuances well in advance and not plan it right in the end of the financial year.
Right. So I want to talk to you about some of these niche options which not many people are aware about. But just before getting to that, amongst the usuals or ATC, the NPS is one avenue which would make it more attractive because it has the additional 50,000 benefit which others don't have.
Absolutely. I think, see, anything which you were anyway going to do, and if you get a tax break on it, it is like a super benefit. Why? Because participating in equity and having an equity portion in your portfolio is, and a pension kind of a retirement objective is more or less everybody's requirement. So if by doing that, over and above, if you get a gift of 15,000 rupees every year, because 50,000 rupees, if you're in the highest tax bracket, then you're saving 15,000 rupees on day one. That's too much of a benefit to let go of. So that's a very, very good option because you're able to put half your money at least in equity and the cost of managing NPS is 100th times the mutual fund cost. If mutual fund costs you 2.5%, this costs you 0.002%.
That actually brings me to the next point of ELSS funds. Given the kind of investor interest that we're seeing these days in mutual funds, how attractive is ELSS funds as a tax saving mechanism?
See, ELSS is very, every year the attractiveness of ELSS changes marginally. Because if the markets have run up significantly in the previous year, and then if you're getting markets at a very high price, then ELSS over the next subsequent 3 years will not give you very good returns. So today, if you sit at 7,800 of Nifty and 26,000 of Sensex, these are very, very reasonable valuations to buy the market. Because even after the general elections, you don't see more than 500-600 points on Nifty added up. So ELSS this year could be a very, very good mechanism to create the ATC if you have not exhausted the limit already.
Another very attractive option for HNIs especially would be the tax-free bonds.
See, when it comes to tax-free bonds, their nomenclature is a little deceptive. Okay, tax-free, they are not tax-free from an exemption perspective. They don't give you any tax break. But the income you earn from them is tax-free. So you have exempt income instruments. Here, this is just exempting the income which you're going to earn. For example, if a tax-free bond says you're going to make 7.5% interest for the next 10 years, paid yearly, that 7.5% is tax-free. By the virtue of investing in that, you don't save any tax. You only save the tax on the potential income that instrument is going to earn you over periods of time. So, but yeah, they are definitely an integral part of an HNI's portfolio, because in the falling interest rate situation, if you're able to block 7.5% post-tax, it's as good as having made a 10% FD, fixed deposit, for a highest tax slab individual for the next 10 years, which is very, very lucrative.
The other part, Feroze, is the double indexation benefit that some of these bond funds have. Can you just take us through what that means and how does it work?
See, a double indexation, as the nomenclature suggests, is giving you a more indexation than you actually have stayed invested.
Right.
Unfortunately, after the interim budget, which was announced after this new government took over, debt funds had become a 3-year investment, no more a 1-year investment. So it's no more double indexation, it is 4 indexations.
Right.
Now, if you invest in this quarter, for example, you are investing in the financial year 15-16.
Right.
Correct?
Right.
So if you invest now, one financial year is 15-16.
Yes.
Then you have 16-17.
Right.
17-18.
Right.
18-19.
Right.
And then when you exit in April 2019,
right,
you would be stepping into the 5th financial year.
Right.
So if you're investing actually for 3.25 years, but you're actually overlapping in 5 financial years.
Right.
So you will get 4 indexations for 3/4 years.
Okay.
So if indexation is 7%, you will get 7 into 4,
right,
which is 28. And you will almost have a complete tax-free income because of 4 indexations
right,
and 3/4 years of return.
Right.
So double indexation, which ideally meant that you have 1 indexation more than the number of years you've invested, which makes it a potential tax-free asset. So debt funds bought in this year and held for little more than 3/4 years will give you post-tax equal return to pre-tax, which is a very, very important
right,
thing.
Right.
So you should build your portfolio on the debt side during this quarter, which is the first quarter of a calendar year or the last quarter of a financial year is the best time to build your debt funds portfolio and get the benefit of the indexation which you were mentioning.
Right. And the other one which most people are not aware about, that many of these close-ended real estate funds or such, the AIF funds have an indexation benefit that one can really make use of?
Correct. Yeah, that's again a very little known fact. Under Section 48, which speaks about cost of acquisition and indexation, what happens is there are only 2 assets which are not included in that is bonds and debentures.
Right.
So these real estate fund units, for example, if one has bought a real estate fund 8 years back, okay, if he has made on his 25 lakhs made only 5 lakhs or even 7-8 lakhs, he can index his 25 lakhs and if you look at 8 years of indexation, the 25 lakhs would actually be worth as a cost of acquisition as 50 lakhs. So you can actually create a notional loss of 15 to 20 lakhs and use that loss to offset against any other capital gain which arises from any long-term asset which is being sold.
Okay.
So that's a very good tax break of you being able to save 5 to 10 lakhs on a 25 lakh old investment 8 years back.
Right.
So net, Section 48 permits you to index those units of mutual funds, not just mutual funds, closed-ended funds
right,
like real estate and private
right,
equity funds,
right,
which HNIs generally
yes,
invest in. So that's a very, very
but
good
that
tax.
would work more when, as you said, the fund, say, has not performed very well and you offsetting it with a loss, right?
Correct. But if the fund is performed very well also, it will make you get you tax-free incomes.
Okay.
Otherwise, if you don't index it, you will end up paying a tax on it.
Right.
So if you have made 10 lakhs and if you don't index it, you will have to pay tax on the 10 lakhs.
Right.
Okay, so you will either save tax on the income generated by the fund, or if the fund is not done enough, then you will get a tax loss which is notional, which can be used to offset any other long-term gains in any other asset.
Right. And finally, Feroze, what are some of the biggest mistakes or misconceptions maybe that you've seen among clients, among investors with respect to tax planning or when people are investing at the end of the year for taxes?
See, I think there are 2 things. One is people generally invest with the primary objective being tax.
Right.
Okay, you have to see what you are going to invest in, any which way, and which are the instruments which give you a tax break as an additional benefit.
Right.
Your primary or your prerequisite can't be taxation,
right,
which especially in the early stages of one's financial planning, he ends up taking a choice because of tax.
Right.
And the second thing is, tax can actually be managed for the next 5 years without actually repeatedly interfering with the tax planning.
All right, Feroze. Thanks very much. We'll leave it there.
Thank you.
All right, time for another quick break. We'll come back with the mutual fund report card. Stay tuned.